Hello, everyone. My name is Wambui Chege, and I'm the chair of the Making Finance Work for Africa Partnership. I'll just give us a few more minutes before we start our session today. So just give us like 3 more minutes and then we'll start on the dot. So good afternoon, good morning, wherever you are in the world. Welcome to our special webinar series focused on COVID-19. We have been running a series of webinars this month on the impact of COVID-19. This particular session will focus on how development finance institutions are responding to the pandemic and what they are doing to support the African financial sector. My name is Wambui Chege, and I'm the independent chair of the Making Finance Work for Africa Partnership. So can we move over to the next slide? All right, so before we begin, a couple of reminders. Please note the following housekeeping rules. Next slide, please. So today's session is going to last for 1 hour, but given the way the other sessions have been running, we expect to run over just a little bit, but we're going to be around for 1 hour. To ensure the highest quality of experience, we ask that all participants be muted. All questions can be submitted via the chat or the Q&A button on the screen. If you want to ask a question, please click on the raise hand icon to speak. Slides and recordings of this presentation will be circulated to registered participants within 72 hours following the webinar. They will also be available on our website. If you have any issues with this session, please message the organizers, and you can do that via the chat. And we ask that please don't forget to fill out the survey that appears automatically after the session. We had over 600 people registered for this webinar. Because of the limited capacity, not everyone will be able to get onto the webinar. Right now, we have about just getting into 100, and we expect that we're probably going to get to full capacity in the next 10 minutes. But not to worry, we will be circulating the recording of the webinar to everyone who has registered. So I'm going to start by introducing the Making Finance Work for Africa Partnership, and I'll just like to ask my colleague to move us to the next slide. So Making Finance Work for Africa is an initiative of the G8 that was launched in October 2007. We are a unique platform for African governments, the private sector, and development partners to coordinate financial sector development interventions across the continent, avoiding duplication and maximizing development impact. Our work covers 3 core areas: financial inclusion, long-term finance, as well as financial stability and regulation. All this is underpinned by knowledge management and advocacy, which is cross-cutting across all 3 areas. Our current members include the African Development Bank, GIZ, AFD, European Investment Bank, the European Commission, the Dutch government, the federal government of Germany, and Afri-Exim Bank. As mentioned earlier, this month we held a session where we discussed the impact of the pandemic on the African financial sector. I will now invite our financial sector advisor, Hugh Kamewe, to present a summary of those discussions. Over to you, Hugh.
Okay. Thank you. Can you hear me?
Yes, very well.
Okay, good. Thank you very much. Yes, the purpose of the next three slides is to give a bit of context to these conversations between the DFI. And the context we want to bring is basically try to explain why we are moving from a global health, for this first slide, global health emergency to a kind of recession, or even one of the worst economic crises that we have ever experienced in many decades. The reason is very simple, that this pandemic, the COVID, is disrupting an interconnected global economy with a significant impact on global value chains. The economic effect at macroeconomic level, the economic effect are being felt through multiple channels, which include the reduction in trade, financial flows, tourism decline, price of oil, gas, and other commodities, and also an increase spending in public health spending related to the COVID. The potential cost for the global economy is estimated around 1 trillion of output losses, and in Africa, the estimates are between 40 billion to 80 billion in US dollars in terms of output losses, which represents around -2 to 8% of GDP loss, depending on the baseline scenario. So Africa will really enter the worst crisis it has ever experienced in 25 years. For some of the countries coming into this crisis with high level of debt and high dependency on commodity, we are expecting that they have very limited fiscal space, and that will constrain the ability to respond to the COVID crisis and manage the wider economic impact. The next slide is more focused on the financial sector particularly, and it really shows that countries are running the risk of financial distress simply because of the collapse in borrower repayment capacity, which are leading to high non-performing loans and the reduction in profitability of financial institutions. That also will lead probably to non-compliance with certain prudential ratios. So at this point on time, what is very critical is the provision of liquidity and flexibility in capital requirement. We also have to bear in mind that going forward, some of the banking systems, our banking system will become vulnerable, and some of the banking system may require recapitalization and restructuring. The third slide, it's more about the expectations that we received from previous sessions, the two past webinars that we had on the COVID, and some of the expectations raised by the participants. And I will not go through over the relevant recommendations that are outlined there. I'll just take two that for me speak directly to the DFI. They are requesting that there is kind of partially de-dollarize financial assistance and provide long-term resources at preferential rate. They are also expecting that we can ensure regional coordination of response in support to the financial sector. I think this is a very big agenda, and I don't know whether we will have enough time to cover it, but it's very interesting. Finally, next slide. Next. The next slide will be about, it just shows some of the policy, COVID response facility that are developed. Next slide, please. Yes, some of the COVID response facility that have been made available by the international community. Not all the facility are really cover the financial sector, but at least it provides some response to the need of the public and the private sector, generally speaking. I think our panelists will go more detailed on what their institutions are really have developed as a COVID response facility. I will stop here. Thank you very much.
Thank you so much, Hugh. So we're going to move over to our next section of this session, which is the actual presentations by the panelists. We've got 4 speakers today. I'll start with Stefan Nalentambi, who is the Director of the Financial Sector Development Department at the African Development. Over to you, Stefan.
Okay, good afternoon, Wambui. Can you hear me?
Yes, very well.
Okay, so good afternoon, everybody, and it's good to be speaking to you. Unfortunately, I can't see you, but it's very good to be speaking to you. So maybe we can move to the next slide. Okay, so really in the FDB has more or less our lending program of the year is about, let's say about $11 billion. And of that $11 billion this year, and this is of course for both public and private sector, you've got to understand the bank covers both types of clients. About $10 billion is going to be very much dedicated to this response to the COVID crisis. Now, of course, the COVID crisis, as was mentioned by Hugues, is both health initially, and of course, it's led into an economic crisis, as of course we know that we're all in lockdowns. So we have to obviously support both our public and private clients, public ones being mainly the governments. And what we're trying to do, and of course, we're working very closely with our friends of AFD and all the others, IMF, World Bank, etc., is of course there's going to be the G20 initiatives, but at our level, beyond the debt deferral that is already being discussed and I think has been approved by G20, there is all a discussion around how we support basically the budgets of these countries, the economic fallout, the lack of taxes coming through, and so make sure that they have some resources for the budget. But alongside that, and I'm sure AFD will allude to this much more than we are, there is of course got to be very much beyond the supporting just the economies in surviving in terms of liquidity for the governments. We also have to make sure that we do have a public health approach to make sure that we are actually looking to see, well, how are we going to really address these public health issues as we go forward? Because all of us, as we see on the continent, mainly, a lot of our countries are actually suffering from right now is the issue about how do we test and how do we manage the pandemic itself. But anyway, so there's all that part of the money that is going to the governments, and then there's part that's going to what we call our non-sovereign operations, non-sovereign clients. Now, what are we concerned about there? These are not new clients, of course. These are existing clients because we want to make sure that they continue to are supported during this crisis. These clients are from the financial sector, they're from the transport sector, they're from the agriculture sector, they're from the industry, manufacturing, and they're from the energy. So the point there is to support them. And in the non-sovereign instruments, we have different types. Some of them are linked to actually the debt that they owed us this year, where we can actually do what we call debt service deferrals, where we basically postpone, if of course they have a good reason, we postpone their expected obligation, the principal of their obligation to the next year. We've also got some short-term liquidity facilities, trade finance and guarantees. Why we have these different facilities? Well, it's also to provide working capital to some of these institutions so that they can ride the wave. Some of it are through banks, and we will be working with regional DFIs, amongst others, but also some systemic banks in certain countries, and also some of our clients. But I mean, as you can see, this is not only for banks, it's also for corporates, be they the short-term liquidity facility or the debt service deferrals. I think I'll stop here. Next slide, actually, sorry, next slide. So yes, what is the really what we're trying to do? And this again, coming back to what I mentioned earlier about we're working with our partners. On the real sector side, when you have a lot of NSO, what we call non-sovereign lending, a lot of it is linked to club deals because these are mainly, let's say, transformative deals with big corporates in a lot of our countries. And so these are club deals, and the negotiation takes place at a very high level. It's not only FDB that's going to be able to defer the debt or to even think of restructuring the debt if that is part of the discussion. That has to be at the club level. So you can well imagine these conversations are ongoing right now, and these are very tight discussions that go on. And of course, we've got to make sure that we're supporting the communities in a way that when we, first of all, to survive, let's say, the lockdown, but beyond the lockdown, to be able to support the economies picking up again. And this is where we obviously are in this NSO space, focusing on some of the banks, but also some of the real sector clients, especially in the, to be honest with you, it's mainly the food chain, the value chain, food, agriculture, and some of the energy value chain at this point. Is there another slide? Next slide. Is there one?
No, I think that's it, Stefan.
That's it. Okay, so basically, as I said, it's about $10 billion, of which 8.5 more or less is linked to the public sector, knowing that, of course, it's in ADB and ADF countries being our low-income countries and our fragile states, that collaborate on ADB terms, and the other countries being ADB, and 1.5 billion is for the private sector. Thank you.
Okay, fantastic. Thank you so much, Stefan. I'm going to invite our next speaker, Mr. Intong Eric Monchu, who is a Senior Manager Trade Finance at Afri-Exim Bank. And while Eric is speaking, I'm going to encourage people or all our participants to please send through your questions. We are collating them, and we will have an open Q&A session immediately our four speakers finish speaking.
Okay, good afternoon, everyone, or good morning, good evening, depending where you are. Thank you very much, Wambui, for this very beautiful introduction. And thank you, Stefan and Uyuk, for actually explaining very clearly the problem we have at hand. So sometime around mid-February, the African Export-Import Bank sensed that this coronavirus issue was going to become a pandemic. So we started developing a response. We actually learned from what happened 3 years ago when the oil prices collapsed and a lot of African economies were struggling. We had to provide a response to support central banks and governments. So that gave us the opportunity to learn from experience. So we then developed this rapid response, which we call Pandemic Trade Impact Mitigation Facility, PATINFA. This is a 3 billion facility aimed to be extended to sovereigns, central banks, financial institutions, and corporates to provide them with the liquidity that will help them avert the impact of COVID-19. The first thing that comes to mind is that when you look at it, you think it's a drop in the ocean. It's a small amount. As Stefan said, African Development Bank has put in place a response. Afri-Exim Bank has put in place a response. All these responses, we work together to synergize our efforts to be able to support our member countries, African governments, financial institutions, central banks, and corporates. The facility can be extended as a funded or unfunded. That means we can give it as a loan for up to 3 years, or we can issue various financial instruments such as guarantees for up to 3 years. Eligible entities which have highlighted, sovereigns can apply to see how they can use the proceeds of the facility to support their budget adjustments strategies. Central banks can apply to see how they can use the liquidity to continue honoring their trade obligations, supporting financial institutions in their various countries. Corporates who are importing COVID-related materials like PPEs, ventilators, masks, and everything related to COVID can also benefit from this facility. Typically, we will structure it on the strength of the financial standing of the entity that is applying. If the financial standing is satisfactory, it could be extended as a clean facility, but we will always explore various security, collateral securities that can enhance the structure. The facility normally is priced to take into account its purpose. The mandate of African Export-Import Bank is to promote and finance intra and extra-African trade. So it is a developmental mandate. Though it is commercially priced, it takes into account the importance of the intervention. So we think that this is a support that is very much receiving a lot of response. We've had an inundation of applications where sovereigns have reached out to us, central banks as well, corporates, and commercial banks. We think that is going to provide the necessary support that is required. So I think we can move to the next slide. Okay. No, one slide back, please. So once this facility is extended to these eligible entities, we expect the sources of repayment. Take, for instance, if it is a sovereign, the sovereign can assign identified receivables, either from mining royalties, identified export proceeds from commodities such as crude oil, iron ore, gold, copper, local sales proceeds. We can also use securities like local currency cash collaterals to be able to secure the facilities in an event where we cannot lend clean. We can also secure the facility using treasury bills or government bonds and any other identified sources of repayment that can be mutually negotiated and agreed. So in a nutshell, this is an intervention, like I mentioned earlier, that is receiving a lot of positive feedback, and we are actively working 24/7 to make sure we meet the need. We'll be happy to take any questions, any further clarification that will be coming from the participants. Thank you very much.
Wonderful. Thank you so much, Eric. I'm going to invite Xavier Moron, who is the head of financial systems at the AFD, to present to us what the AFD is doing.
Good afternoon, everybody. Do you hear me?
Yes, very well.
Okay. Well, so the first immediate response I would like to mention from AFD, because it has been labeled as the COVID-19 Health in Common program. This is not a topic for today in terms of because it's not the financing that will go through the financial systems, but I just would like to mention it because it's important with regard to the crisis and the health crisis to have this in mind. And it has been mentioned on one of your slides with the AFD logo. So just to make it clear, this is a program for health projects where we're trying to redirect our current budget allocation towards more health programs and help the governments face the crisis and its immediate consequences. We thought that it was designed a month ago now. We thought that there was still some very narrow time for the government to prepare and be ready to face the crisis. But the main topic for our discussion today is our response to the financial systems. As you know, AFD is a development bank, and we don't have the same retail network and responsiveness than a commercial bank. And so if we want to bring a rapid response we think among ourselves, we made some housekeeping and say, okay, look, we know that our client, our partners always say that we take a long time. Our appraisal process is very long. We have financial issues to be checked. We have compliance issue, governance issue. But in the meantime, we succeed in providing financing. But within the crisis coming, we said, what can we do to make sure that we are a bit more flexible? And it was part of the initial presentation. I saw flexibility several times as a request from clients. And we think about it, and we found two immediate responses where we think that it could be of good impact if we are able to implement them. First, we decided to look at our existing credit agreements and make sure we are able to fast track and ease disbursement. Even if we keep in mind our result framework, our operations are always linked to SDG achievements and the Paris Agreement for climate. But we said within these very difficult times that we could postpone the fund justification for a little moment. We just pause, actually. It doesn't mean that we don't care anymore about this objective. We care. We do care a lot. But given the needs, the short-term needs, we decided that it's possible for us to just bring some flexibility in the disbursement process and make sure that our partners, our clients, are able to prepare for the crisis. The second immediate action that we were able to take is to provide an additional top-up up to 500 million to our existing clients and partners by building on a recent appraisal process. So by doing so, we are able to have our processes and make sure that we will be able to disperse within the first half of the year. As a third point, I would like to mention that it's more important for our subsidiary Proparco dealing with private sector. Proparco, they are not here today. My colleague will be here with us for the French session tomorrow. But I just wanted to mention that in the meantime, we are at the AFD Group working with the European Union to design additional guarantee mechanisms. And there is a new operation in, as you know, the risking will be key given the rapidly deteriorating environment. And that will likely materializes to rating downgrades in the financial sector, and especially in the microfinance segment. We are a development bank, but we are a banker. And as a banker, we also have our own regulations and to comply with. And it's really important for us to build this de-risking mechanism to preserve our own lending capacity as DFI. Second slide, please. Oh, you are already there. On the second round, basically, we would like to keep what we are doing as development partner, but try to do it better. We need to be ready to provide public financial institutions with resources, long-term resources to enhance their counter-cyclical role. And I just would like to remind you that after the 2008 financial crisis, the public financial institutions increased by 70% their financial commitments to support the recovery phase. So this recovery phase will cost a lot of money, and we really need to be ready for that. And there is a good hope as well that we can leverage on regional development banks. And it was mentioned also in your presentation, I saw a bullet on that. So basically to build on regional banks to maximize impact. They have good financial health, important balance sheet, and I think we can leverage on them to to provide more financings. We also think that we need to pay more attention to the financial inclusion sector and make sure its recovery will be rapid and also its capacity preserved first and even enhanced. Because we clearly need these stakeholders to provide basic financial services to the most vulnerable population. Because we also know that this microfinance segment works as a social safety net. What we would like to do and build after crisis is to help financial authorities, I mean regulatory bodies, build resilience by using the current crisis negative impact on the financial sector to better understand and address their vulnerabilities. Nobody actually, from north to south, nobody was basically ready to face this magnitude. And we'll probably need to look backward in a moment and see how we could have built some buffers, and these buffers will be useful for the future. How to encourage, for instance, basic insurance services from the microfinance institution will provide some resilience for income generation in the vulnerable population. That's a key element. As a development partner, we are here to accompany and accelerate transformations with regard to the 2030 agenda, including climate and SDGs achievements. And within the crisis, there is no way that current vulnerabilities are being washed away. We'd rather expect them to be increased, even exacerbated in the aftermath of this crisis. And I will be very surprised to hear somebody over the line who think that there will be less social, gender, jobs, shared growth challenges, and even climate concerns that are diminishing after this crisis. I'm pretty sure that you all agree with me that it will hiking. By accelerating transition, we also think that digitalization is also a key element to accelerate. And I think this crisis has demonstrated severely. Going through the lockdown period and social distanciation, it has made digital even more important. And as far as the financial sector is concerned, digital finance services have been probably the way to keep doing business, as the space for cash in hand is basically narrowing. And the final point, I just would like to, this is my final point, and as I mentioned, the sustainability remains a key word. And we would like government and financial sector stakeholders to keep focused on that. There is a huge need for a green and inclusive recovery. And for sure, at the early stage of the response, government's intentions will probably be diverted from this overarching objective. But as development partner, we'll be here to provide the right incentives to get them back on track. I thank you. Thank you for your listening.
Thank you so much, Xavier. And it's really good to hear some of the issues that you've highlighted, especially moving around to a greener economy and the importance of social issues becoming more important for economic development. I'm now going to invite Zef Ntleko, who is the Chief Economist at the Development Bank of South Africa, to tell us what the DBSA is doing in terms of COVID.
All right, thank you very much, Womboy. So we had to take a comprehensive approach to assessing what needs to be intervened on. We were, for example, aware that banks and the non-bank financial institutions are already offering relaxations in repayments for loans, premiums, and things like this. We are aware that the government has set up a fund to assist small businesses through loan guarantees. And the central bank, of course, had reduced interest rates by about 225 basis points from the beginning of the year. And they were embarking on buying bonds actively. So we focused on 4 priority areas, namely to ensure that there's business continuity, ensure that we support the data analysis from the testing and tracking of the disease, that we support actual management of the health crisis as well as the economic impact. So this particular slide is showing that we had to take a direct response to the fight with the disease, namely by contributing to an existing fund and supporting the Disaster Management Center as well as the PPEs that are required. Also, to make sure that we continue inducing productivity in the economy, because take a longish view on finance. So we were supporting the municipalities, for example, to make sure that it continue functioning. Go to the next slide. You'll see that we then adopted these initiatives because we are putting a lot of emphasis on the economic recovery. And we're doing so through making sure that we support the preparation and the building of projects in the country, support government and the municipality in setting up their district development model, and we ensure that the fund that we are setting up is operational by 2020, that is the infrastructure fund, of course the setting up of the digital lab. So in the preparation and building of projects, spending a lot of time in assisting particularly social and economic infrastructure, make sure that as we come out of this disease, there is a lot of prepared projects that are ready for funding and that are implementation. The district development model as well as the infrastructure bedrocks and other key instruments that we want to use to ensure that the economy recovers and takes off after the disease. The infrastructure fund, for example, is going to be supported by the projects that are being prepared. Let me stop here, Wamboy.
Zeph, are you still there?
Yeah. Yes, you'd like me to continue? I was stopping here. Can you hear me, Wamboy?
Yes, now we can.
Oh, apologies. I was finished. I was checking if you have more time for me to go on.
Yes, just a few more. You could finish.
All right. So the key issue then for us is to ensure that as the economy recovers, there is meaningful impact. So, for example, we think regional coordination of responses is going to be the basis for this, and we think that we have to support that coordination at a regional basis. Secondly, we think that the borrower's capacity to repay is going to be severely hampered, and therefore we have to anticipate, for example, an increase in non-performing loans in the medium term, for example. But also the question of markets that are not recovering very quickly are going to put a squeeze on. So those are the key issues that we will be paying attention to. Thank you very much.
Okay, wonderful. Thank you very much, Zeph, for your presentation. We're now going to move over to the next part of this webinar, which is the Q&A. And I'll encourage everybody who is here to please submit their questions through the chat on your screen. We will be collating the questions. To start us off, we have a question from Radha, who is asking, how can DFIs de-dollarize? Even before COVID, this was seen as a key issue with DFI funding for farms in East Africa, for example. Lending was in dollar terms and not local currency. So this question, I believe that Stefan is going to answer this question.
Yeah, I see. Thank you for giving me the hard ones. Very simply, to be honest with you, the de-dollarization is still an issue. It was an issue before. It still will be an issue. It won't be able to change very much right now, but we do have blended finance products which allow us to do in certain cases, depending on the level of development in the local swap market, we can do some local currency interventions, and it does happen. Now, it all depends on who is the customer and the quality of the customer, and also in certain cases, it also depends on the interest rate environment in the local currency. Because honestly, to be borrowing at 30-35% for 5 years is not maybe the most exciting thing to do. So the point is really, and I take the discussion a bit higher level actually when I discuss it with the governments, I always say, well, yes, of course, we should be encouraging local currencies, but we should be encouraging local currencies in environments where debt is sustainable in terms of lending. You can't lend for 5 years at 35%, you're basically, it's costing you a fortune. So the point then becomes, how is the monetary policy conducive for us to be able to be supporting local currency to fund housing, for example, at 10 or 15 years? But that's a different discussion at some point. It's definitely on the cards. To be sincere, the facilities that we have right now are in euros, dollars, rand, South African rand, mainly from our side in the FDB. Thank you.
Wambui, can I add something to that?
Yes, exactly. I was going to ask if anybody else wants to add.
Okay, this is Eric from Afrexim Bank. I think Stefan has beautifully put it. It's a blended approach. If the need is to pay local suppliers, then you see we find a solution to provide a local currency facility. We actually have specialized programs that are being rolled out right now. But the key question remains, the financing you're requesting that a country or an entity needs, what is the financing going to be used for? Are you requesting this financing to import PPEs, ventilators? You're going to pay in foreign currency. So will you rather prefer for me to give you local currency, then you start struggling to buy foreign currency, which is very scarce across the continent, before paying, or you want me to give you foreign currency to be able to pay the suppliers directly so that you can receive the equipment or the supplies, COVID-related supplies or any supplies that you're requesting. So that's the point. That's why the approach DFIs typically use is a blended approach, where the suppliers or the trading partners are supposed to be paid. Remember, a foreign currency facility, as Stefan has said, eliminates that hassle you have to go through to go and procure foreign currency. So most of the African Development Bank or Afrexim Bank will pay the suppliers directly in foreign currency, and you get the equipment or the supplies you're looking for. But solutions in local currency are also available, which can be explored, discussed, and agreed. Thank you.
Thank you, Eric. So also answers one of the questions I think that had been put forward by Francois Tilly, which is how do you foresee the development of local debt currency to support this difficult time, and how can DFI support this further? So I'm going to move on to another question, which is by Suzanne Ekedi. Companies had to lay off employees or put them on technical unemployment. Do you have an estimate on the number of jobs that will be maintained through your facility, support to corporates and SMEs, and how will we monitor that? So I'm going to ask that to any of the panelists to please feel free to answer.
Can I start, please?
Go ahead.
Yes, thank you, Wambui. That's a very good question. One of the key lending criteria we use is development impact. And development impact is by quantifying the impact that will be derived from using the proceeds of the facility. Upfront, when you are providing the facility to a beneficiary, be it government, be it central bank, be it commercial bank or any corporate, you discuss with the corporates and they give you estimates. But what we do is, as the facility is running, we then actually get the actual number. So, for instance, if you're looking at number of employees, you tell us how many people you employ today. Then we look at that and how many you intend, you project you're going to employ, so that we can see the development impact coming out of the process of this facility. So that review is an ongoing process during the life of a facility, in such a way that by the time a facility is end, because we track this for our own reporting, by the time you fully utilize a facility, we have a fair understanding of how many more people have been employed and how many were there before you got this facility and after you procured this facility and utilize it. So it's a very important aspect which we consider before even extending the facility. The whole idea is to sustain employment and to ensure that it is demonstrated and proven that jobs are not lost. That's why this intervention was actually put in place. Thank you.
Great. Thank you, Eric, very much. So I know that Stefan is leaving in the next 10 minutes. There are a couple of questions here that are for him before I hand them over to the other panelists. I'm just going to ask you the questions directly. So one question is, what will be the disbursement agenda of the AFDB 10 billion COVID response? And then, do you think further corona bonds, as issued most recently by the AFDB, could be mutualized and issued by other regional development banks, including in local currency? Hello, Stefan?
Sorry, I was on mute. I had forgotten.
Okay.
I was on mute. Sorry, the first question was about how much we expect to disperse?
No, yes, and if you have a disbursement schedule.
Well, the disbursement schedule, well, first of all, we obviously at this point still collecting the requests. Don't forget, the requests are partly to us, they're partly to the bilateral donors, they're partly to the other multilateral donors. There's a whole work upstream of coordination between the different donors to make sure that we do provide the most effective response, knowing that the response is, as I mentioned when I started, there's an economic response which is linked to the governments being supported in their budget management, but there's also very much a health response which is linked to basically supporting the public health systems and the immediate response, the public health systems now and in the future, and also the immediate response for the COVID, the infrastructure, let's say the infrastructure we right now need to support the COVID counterattack, if I may call it. So this is where we obviously expect to be dispersing quite a bit of the 10 billion that we've put aside. As I mentioned, part of it will come from the AAA part of the institution, which is the ADB. That should be around up to 2.7 billion. Another part will come from the fund, the ADF, which covers around 28 to 30 countries, which are the LICs and the fragile states. And this is linked to their own allotments, which is linked to the 3-year cycle of funding of the fund, the Africa Development Fund, which has actually just been replenished at record levels. So the point is, the ADF will also be very much involved. And finally, of course, as I mentioned on the private sector side, so we're still working on the numbers. We know that we should be dispersing by mid-June or early July about 1.6 billion on the ADB countries. And we should be expecting to do a second round linked with the ADF countries and the NSO world from July onwards, which should be also quite substantive. So I mean, there is a lot of money, and this is the point. It's a very different type of instrument that we've been using traditionally, and this was also mentioned by Xavier. The point is we're all actually adapting to the current situation. We are institutions that usually work on project-based lending, which is much more long-term type support. We have 1 or 2 instruments for short-term, but we basically are much more tilted towards longer-term instrument support. And also our processes are like that. And as you can well imagine, it's a revolution within our institutions, where also we're looking to be much more streamlined in the way we process things, of course, maintaining the same quality and respecting, as was mentioned by Xavier, all the issues related to the environment, to development outcomes, etc., additionality. So anyway, so that's for your first question. The second question, sorry, was?
Yeah, so thank you for that. The second question was, do you think further Corona bonds as issued most recently by the AFDB could be mutualized and issued by other regional development banks? And I think this speaks to your point that you had made earlier, that you would be working with other regional DFIs in the disbursement.
Okay. Yeah, sure. And I'm sure that Eric can speak to this, as Afreximbank, of course, is looking at their borrowing, their funding instruments for this year. I'm sure they're going to be changing the mix from what they would had originally expected to be doing. What we're doing, as you can well imagine, in this type of crisis, the weaker credits are even weaker than before. And as you're well aware, on our continent, it's more difficult. And Eric alluded to it in his response on the local currency issue. For local banks, even for African banks today, to borrow in dollars, it's going to be an arm and a leg in terms of cost right now. So I don't imagine the market isn't really open for emerging markets, let's say frontier market type borrowers in dollars. Right now, it's not even open. It's practically closed. So I would say one has to be conscious of what one can do. So who are the borrowers that can do some stuff? Yes, Afreximbank can, because it's got an investment grade rating. TDB could also. So there could be others of our BOAD also could do it. We have some of our regional banks that could eventually issue in foreign currencies, and we would be willing. I mean, the AFDB could obviously provide a guarantee, a partial guarantee there. So could AFD, if I'm not mistaken. I'm sure they could. So the point is, this is a possibility for the regional development banks that have a certain level of prestige, because they are the quality they have will enable them to be relatively, let's say, targeted in terms from the investment community as potential investments. Whereas the junk, what we call non-investment grade type issuers, it's going to be very, very difficult right now for them to be able to get adequate terms in foreign currencies. So yes, it's an option as well. So the COVID response bonds was a short-term bond. It was a 3-year, if I'm not mistaken, that we did. And of course, it's helping us manage the liquidity that we are expecting to be dispersing quite quickly. That's why we had to borrow quite a large amount, because we don't usually do that bigger type borrowings. But it was clearly linked to the fact that the pandemic is changing the way we're working in the short term for the moment. Thank you. Hello?
Hi, sorry, I think I muted myself also by mistake. So thank you very much, Stefan. I'm going to ask.
Okay, go ahead. Sorry.
Yeah, I'm going to ask some of the other panelists to answer. So there's a question here that I think Xavier should take, which is: the youth are the future of Africa. What specific strategies are in place to support the youth who do not seem to have confidence in traditional financial institutions?
Well, that's a big one. So the entire African future, as the population is very young, and to me it's related to jobs jobs creation, and SME, financial inclusion, financing. So basically, we have to foster all these instruments together. We cannot expect any over. I would say we need to work all together and find the right mechanism to reach the most vulnerable people, and youth are part of it. They are the future for Africa, but they also need to get good health, a job, to create value added and bring prosperity in Africa. So this is basically the question of development, and we know that the challenges are huge. That this will need a lot of money. This will need capital market creations, enhancements, a lot of things that, the question is basically too huge to answer. But for sure, we need to create more instruments through financial inclusions to reach all these people.
Wambui, may I come in? Or I have to leave?
Yes.
Just to add to what Xavier is saying, and we're all actually working that quite actively, and I know Poparco is working with us on several issues. It's through a lot of it. There's two angles to this. One angle is, of course, the skills development for youth, which is very much linked to education systems, supporting training, etc., etc. That's more the grant side of things. But there's also the productive side, which I would call is linked to the supporting startups or early stage entrepreneurs. And all of our institutions, including Afrexim Bank, is starting to work on this. We work quite a lot now on these, either what we call social impact funds or venture capital funds, which are very much supported for the youth and for women, of course, and even the middle-aged people, by the way, but who want to start their businesses and who have actually thought through in such a way that their business plan can be funded. And this is all links up with a lot of governmental work which has been done. And why I'm mentioning the governments again is because you have a lot of trust, you have a lot of grant money that comes to support governments in creating these incubators and accelerators across the continent, which do cater for a lot of these different, they've been school leavers or university graduates, or even just people who've been at school earlier on in their youth, who want to start businesses and who have a really good idea. They can actually find funding, and all of us do support that. We obviously need first loss guarantees, and we go through the approach called fund of funds approach, which means that we use the expertise of people who identify these small entrepreneurs, and we support them with some grant money, some seed capital for them to be launched. And obviously we accompany them, not only financially, but also technically, for them to be able to really develop their businesses, because we know the first 5 years of a business are crucial, and the success rate is quite low. And this is where you need the support. And sometimes it's a lot of hand-holding that does go on in a lot of our countries today, and it's becoming a very, very big market, to be sincere. Thank you. And it does cover, it also works, sorry, just to finish, it also does touch rural areas. It's not only about cities, it's also in the rural areas as well. So please, these are things we can obviously provide more information on if you're looking to be, to benefit from this type of facility. Thank you.
Thank you, Stefan, and thank you, Xavier, for those pointers. So we have a question from Jan, who would like to ask a question. Jan, may I ask you to please unmute your mic?
Yes, I'm muted. Hello.
Please go ahead.
Okay, thank you. You can hear me?
Very well.
Thank you. So hi, everyone. It's a pleasure for me to participate in this webinar. And my question is towards, I think, all the panelists. And I wanted to throw the debate or the discussion about the the feasibility of putting in place an independent oversight mechanism over all the actions that will be done by the DFIs towards the financial sector mainly, but knowing also that all the other actions that will be done by the DFIs will go through the financial sector anyway in order to be deployed. I wanted to throw the debate and ask the question what they think about putting in place an independent oversight mechanism that could serve three purposes. One, to aggregate centrally the information about the entire action towards, the financial sector, the beneficiaries at large. And this independent oversight mechanism would be able to, provide an overview of everything that is done by the DFIs in order to avoid, duplicates or redundancy and to foster efficiency and complementarity of actions. It can also be a platform to provide data indicators to the DFIs, mainly from the beneficiaries, a three-way communication feedback process, and also to the large public to foster transparency. We could go into more details, but as the time is short, for now, this is my question.
Sure, thanks. I'm going to ask David Ashiagbo, who is the current coordinator of the program, to respond to that, because some of the work that the partnership does already covers some of the aspects that you have spoken about, Jan.
Thank you.
Thank you, Wambui. I wasn't prepared for that. Thank you, Jan, for that. I mean, I think there's obviously a lot of work to be done in terms of coordination, and that's, as Wambui says, it's one of the things that we do at Making Finance, and actually one of the ideas that we are working on as part of our response to COVID is asking our partners the question, how can we support you to coordinate better? So we're doing things like these webinars are a part of that. We're doing things like putting in place a dedicated sort of COVID resource portal. That will probably take a bit of time on our website, where we are collating information about, what everybody, all the DFIs and, well, actually all the COVID related interventions, not just those by our members, and looking at how we can support them through creation of working groups, etc., etc. I also know that the AFDB is working on something similar, because there's a virtual meeting tomorrow. I don't think it's public, where they're going to be talking about how to better coordinate responses. So I think that's part of the answer to your question. But I think, obviously there is a difference between coordination and oversight. And I personally think if you're saying, you want oversight, then the idea is that, if something is not delivered, you hold somebody accountable. And I think that in this context, it's quite difficult to see where those accountabilities would lie. But I think, better coordination, exchange of information, working together is something that we at Making Finance would definitely like to see. And I just to link that back to today's discussion. When I was listening to the various presentations, it struck me that Stefan's presentation, so the AFDB response, was very much and Afrexim to some extent, we're very much focused on what are the short-term liquidity needs and what needs to be done immediately in order to make sure that the wheels keep turning. What struck me was that AFD and DBSA seem to be taking a much sort of longer view, right? So particularly DBSA was looking at project preparation, is looking at project preparation for the recovery. So I think already things like this provide a good platform for coordination, because I think we're all aware that, yes, you need the immediate response to make sure that the wheels keep turning, but also what happens when this is over. So that's a very long answer to a very short question, but I hope it addresses some of the issues you raised.
Yes, thank you, David. Thank you. It does. Thank you.
Add a bit on that.
So I just want to say thank you, David, because that's also a really good point. One of the things that struck me as well as I was listening to the presentation is, so we have all defined our responses as institutions by the short term and medium term, with an assumption that maybe the crisis or the lockdown will end probably in 2 to 3 months, or maybe at most 6 months. But there is a very big question: what happens if this continues for even 18 months? What are the implications for that, for trade within the continent? What are the implications of that for the financial sector? I don't have an answer for that, and I don't know whether we have an answer to that, but it's something to keep in mind as we're moving on. Now, there is a question for DBSA here. So for Zeph, do you expect, first of all, whether the facilities and the funds that you have, whether they are available for funding outside of Southern Africa, and do you expect a growth of infrastructure projects in your region?
Thanks so much. Yes, I think the point that was being discussed now, that was raised by Jan, talks exactly to that. On two fronts, say the platforms such as Making Finance Work, IDC, etc., etc. These platforms should assist us to understand the surpluses and the deficits in the region. Surpluses and deficits on both the supplies for COVID-19 items, but also surpluses and deficits for funds, so that we know where to focus our energies. And on the second front these platforms should also assist us to be vehicles to drive the investment agenda. I think has to be growth in infrastructure investment in the region, but the work starts now. We have to start now putting together the levers and the elements that we want to push. Make sure that when we come out of this, whether it's 6 months or 8 months or however long, we have quite a set of projects that we are going to fund, and the synchronized approach to it, ensure that our efforts are effective and in a balance.
Thank you very much, Zeph. So we're going to wind up now, and I have one final question for all the panelists, and I'd like them to take some time to answer, which is what is the new normal for the financial sector going to look at? So people have been talking about, even if the economies do open back and we go back, we open up for business, it's not going to be a new normal. What will the new normal look like for the financial sector? So I'm going to ask Eric, Xavier, and Zeph to please answer the question.
Okay, thank you very much, Wambui. It's a very interesting question, but if you allow me, say 5, 6 seconds, let me just clarify one point. One of the participants asked that supposing a country that does not have good financial standing approaches Afrexim Bank, remember what will happen? Are we not going to support them to respond to COVID? We will support them. Remember, we said if you have good standing, then the facility will be extended clean. That means no security will believe based on your standing, will believe that you can repay. But if you don't have, that's when we begin to put it together a structure like use of local currency cash or local currency treasury bills or government bonds to find a solution to support you. I hope that clarifies. Going back to the question Wambui just asked, I think the new normal in the financial sector will be for us to believe in ourselves. That's the first thing. Believe that we can stand together and support ourselves. Lean on the support provided by African Development Bank, African Export Import Bank, DBSA, all the DFIs, AFD, and the rest, which we can synergize more and believe that we can start deploying solutions that fit our own realities. We will continue to do foreign currency financing because you need to pay foreign currency suppliers. But more and more for needs that have to do with local currency, where the purpose of the facility is to pay for local currency uses, then we will deploy local currency. So more and more as we progress, you're going to be seeing a hybrid between local currency financing and foreign currency financing, depending on the purpose of the facility. Thank you.
Thank you, Eric. Xavier?
Yeah, from my side, I think we have to see the future and build the future through resilience. And I quickly mentioned it, but I think actually really the good opportunity to think out of the box. Um, we this crisis is unprecedented, and we even don't know actually how big will be the impacts. And for sure, we'll have to look backward in a very short time to analyze and see where we were weak, where were our main weaknesses, and start building buffers, contingent instruments to make sure that I'm not saying that we'll be able to address the entire risk. But what I know is basically when we say this is the first crisis we ever seen like that, it means also that we can also expect a second one. So we need to be ready for that. And rather than trying to fix the past, we really need to finance the future and make sure we are innovative enough to build any buffer that could be needed for the future.
Thank you, sir. Zeph, do you have any comments?
Yeah, sure. I agree with the colleagues. I think a lot of economic damage is witnessed right now, and we see fiscal positions being very, very stretched. So the new normal will include an increased expectation for DFIs to play an even larger role to support fiscal positions and support economies. So in other words, DFIs will be expected to play an even larger developmental role in this purpose. And this will be happening in the context of very, very weakened capacity for clients to repay. So we will have to brace ourselves to be even more developmental.
Sure, thank you. I think that's a great ending to this discussion, because it is true what you have said, Zeph. The DFIs will even have a bigger developmental role, assuming that a lot of the economies are going to be a lot more weakened, and especially the financial sectors. And keeping in mind that if this is the worst crisis that we have had in modern history, the only difference between then and now, or the only difference between, for example, World War II and now, is the fact that there were no DFIs in existence. And so we hope that the whole world and Africa can ride through this storm now that we have these organizations in place. So we're going to send through answers and the script to everybody who was registered for this webinar. And I'd like to say a very big thank you to our organizers, to the team making finance work for Africa, as well as to the panelists for making time for this very, very important discussion. So I'm going to end here and say thank you and bye-bye to everyone.
Thank you very much.
Thank you, Wambui. Bye.